Good morning, everybody. Hope everyone is doing fantastic. We're going to do some Q&A. What questions do you guys have for me? What can I answer for you to help you on your journey with money, with wealth, real estate, infinite banking? What can I help you guys with? Elaine Barlow, how to save on capital gains. I have a rental in a trust. Don't want to be a landlord anymore. So there's a couple different ways you could save on that, Elaine. What you could do is you can invest money from like a self-directed IRA. So you could have funds go into a self-directed, and then anything that you make, any kind of gains, you don't pay taxes on. So it's got to be a self-directed Roth. So any funds that you're putting in there, you've already paid taxes on them once. So then you could go invest and do whatever you want, make as much gains as you want, and you'll never be taxed on it. It'll grow 100% tax-free within that self-directed Roth. And then the only downfall to that is you can't use the funds until you're 59 and a half without a penalty. So you're basically just building up your retirement. So that's one way. You could move to Puerto Rico. Puerto Rico doesn't have any capital gains. I don't blame you on not wanting to be a landlord anymore. Being a landlord is not fun. And when it comes to real estate, it's not a passive thing. Most people will tell you it's passive. It's really not. The only way to be passive in real estate is to basically be a lender. If you're a lender, you can be pretty passive in real estate, but that's the only way, in my opinion. All right, so Diane says, I'm not sure what will help me the most. I think what will help you the most, this is what I learned, guys, is working on yourself will help you more than anything. You can invest in so many things. You could invest in crypto, you could invest in real estate, you could invest in, I mean, the list goes on and on. Oil, you could invest in gold, silver. What's going to help you more than anything is investing in yourself. Invest in your education. Get a mentor. Mentors are great because they beat the learning curve. They've already done things and made mistakes, and they know what you don't know. So having a mentor can help you extremely well from making mistakes that you don't have to make because someone else can teach you the mistake that they've already made. So I would say what would help you the most is getting a mentor, someone that can just be there for you to help you get around all the things that inevitably happen when it comes to investing and when it comes to entrepreneurship, all that stuff. What are your projects for real estate or your projections for real estate market in 2025? With real estate, what I know is happening is there's supply and demand, right? There's not a lot of supply, so the demand is high, right? So people don't want to sell their properties right now because think about if you have a mortgage that's 2% interest, 3% interest, you're not going to sell your property to go buy a property that has a 7 or 8% interest rate. It won't make sense financially. So a lot of people are just on the sidelines. They're not selling their houses. What I think is going to happen in 2025 is I think that supply is going to start going up because just from what I'm seeing here in Phoenix, Arizona, they're building like crazy. They're building so much housing, a lot of condos, more affordable housing. So I think that supply is going to go up, which should it's all about supply and demand, right? So if supply is really, really low, demand goes up. If supply is really, really high, demand goes down. So it's hard to say exactly what's going to happen. It's going to basically, if rates drop, what's going to happen is people are going to start to sell their homes that weren't going to sell because now they can get the next house. They can level up on the house without their payment going through the roof. So the supply is going to go up like crazy, and then they're building like crazy. So I wish I had a crystal ball. What I'm doing personally, and this is what I would suggest you guys do, is stack your money. Be prepared for when things drop, because what's going to happen, I believe, is housing prices are going to drop, but for a very short amount of time, because then supply is going to go up like crazy. So what's going to happen then is the prices are going to go up like tenfold. So you have a very short window to be able to buy properties at a discount, and then they're going to inflate like crazy. So that's what I think is going to happen. I don't know for sure, but can you make your own policies, or you have to stick to whatever they say? So Mel, can you make your own policies, or you have to stick to whatever they say? If you're talking about like a life insurance policy, if you're licensed, you can write your own policy. The policies that we do with my company, this is all we do. We only do policies built for infinite banking. So a lot of people just don't know how to build them like that. So what I would do if you were getting like your first policy, I would have someone who specializes in infinite banking build it for you, and then you know how it's supposed to be built, you can use it, and then you can start building your own. That'd be my best suggestion. Let's see. Sal said, you talked about getting a policy on your dad. How old is he approximately? Did you dump in, and what is the monthly premium? Great question. So my dad, when I got the policy, was 68, and I didn't do a dump in. I just do a set amount per year. I do 40,000, excuse me, $40,000 per year into his policy, and I can do that for 10 years. After 10 years, I forget what it drops down to. I think I can only do, I'd have to look it up, but I think I can only do like 16 grand at year 11 and on, I believe. So what I use my dad's policy for, guys, I've got a policy on my dad, my mom, and my in-laws. I use those policies as a way to help them with retirement income. So I've got a good amount of disposable income. So what I do is I fund the policies. I use the cash value and pay them a monthly retirement income, tax free, because I'm just borrowing from the policy. And then when they pass away, which is an inevitable thing, I don't know when it's going to happen, but it's going to happen. When they pass away, the death benefit pays off all of the policy loans, and the difference goes to my trust. So then my trust dictates that we have to buy more policies on other family members. So whether it be my daughters, whether it be my brother and sister, just to make sure that the wealth stays within my family. Diane says, I have a ton sitting in a 401k and heavily taxed. Should never have listened to advice we were given. 100%. Diane, how much do you have sitting in the 401k, if you don't mind me asking? And is the 401k with an employer, or do you hold it outside of an employer? Like, do you own it, or does an employer own it? So let me know that, and based on that, I can help you out a little bit and steer you in the right direction. Where do I find a mentor? Any professionals that you pay for advice have something to gain by recommending certain avenues to take? I've been buried twice already. So that's a tough one. So when I look for a mentor, what I do is I look for someone, one that I connect with. Like, if I don't connect with that person, it's probably because we don't share the same values. And first, I want to connect with them. Two, I want I want to have their life, if that makes sense. So I want to really see what their life is like on social media. And I get social media is kind of just a highlight reel, but you can kind of get an idea if they're a family person, if they like to travel, if they have nice cars, a nice house. Like, you can kind of get an idea, and you want to take advice from someone that you would gladly change places with. So if I see someone that I connect with, I like how their vibe, and I see their lifestyle, and I'm like, you know what? That's the kind of lifestyle I want. That's the kind of person I would reach out to. What I've done is I've tried to get into different rooms. So I'll go to masterminds, I'll go to local events, and I just try to get around really successful people. And here's the key, guys. You can have someone be your mentor once you've built kind of a relationship with them. One, they'll give you a better price on mentorship. They might even do it for free. Two, you can build more friendships and relationships through them, because they have a circle, most likely very successful people. If they're successful, that's just how it works. So what I would do, this is very important. When you go to local events, local meetups and whatnot, go there with the intent of just learning. So often when we meet someone new, we want to tell them about us. We just want to spill everything about us. And quite frankly, in the nicest way possible, nobody cares about you. I started realizing that when I go to these events, no one cares about me. They care about them. Everyone at their core really cares about themselves. So when you go to these events, if you go with the intent of like, you know what, let me just ask questions about the person I'm talking to, instead of you're going to have the urge to talk about yourself, don't do that. Try to be interested, not interesting. So ask questions. How did you get to where you're at? And then just listen. Wow, that sounds crazy. Like, how did you get past that hurdle? And then just listen. Man, that's incredible. Like, blah, blah, blah. Just keep asking questions about them. What that does is inherently people like to talk about themselves. So if you're letting them do that, they will start to like you. It's crazy. It's just how it works. They will start to like you because you let them talk about themselves and their success. People like talking about their own success because who doesn't like to be successful and talk about it, share it. So really successful people like to share. They like to give what is up here. And how can they do that if they're listening to you talk about yourself, right? So go to these events, guys, meet people, ask questions, be interested, don't be interesting. And what'll happen is you'll start to build friendships, and then through those friendships, you'll actually get mentorship. You'll start to learn the way they think. You'll start to learn little tactics and strategies that they do. Guys, I have not paid for any mentorship because what I've done is exactly what I just told you. I went to meetups, I went to events, I asked a ton of questions to really successful people. I knew they were successful. You could just tell who the really successful people are. And now they're some of my best friends. I have friends that are in the 8-figure and 9-figure arena. So when I started out, my net worth was 300 grand. So I was in the 6-figure arena, and now I'm in 7 figures, close to 8 figures because of the people that I've gotten around. So huge advice I could give you guys is to do that for sure. All right. So we got now Elaine, I'm 75. Can I buy a policy on a relative and be able to borrow from it within a short amount of time? How much do I have to invest to be able to borrow? Great question, Elaine. So you could potentially get a policy on yourself. I have a policy on one of my clients who she was actually 75, just really healthy. If you're really healthy, you can still get a policy on yourself. So I would try that first. If you can't, then you can insure somebody else, like kids, grandkids, a spouse, a brother, sister, a business owner, anyone you have a vested or an insurable interest in, you can insure them. They're the insured body. So the death benefit is on them, and you're the owner. You own the policy, so you own all the rights to it. You can put money in, you can use it right away. There's no seasoning. You can literally put money in, instantly borrow against it within the first 30 days. How much you would need to put in, that's based on how much you can put in. The more you put in, the better, because the more it grows. The more it grows, the more you can use. So that's just something it's based on what you can do. So what I can do for you guys is I can have someone on my team have a consultation call with you. If you guys go to my Instagram, there's a link. And in that link, if you click it, there's another link that says Infinite Banking. Go to that link and you can watch a short training video, which will teach you the concept. And then you can schedule a call with my team. We can make sure to answer any questions you have and kind of tailor make the policy towards you, what you can do and what you're able to do. Let's see. So Diane says I have several million. Wow. And I hold it all. That is amazing. So what you can do, and actually let me ask you this. How young are you? Because that's going to be another factor behind it. If you're really, really close to 59 and a half, that's going to determine what you should and shouldn't do. So Diane, let me know how young you are. My mom always taught me, don't ever ask a woman how old she is. Always ask them how young they are. So how young are you, Diane? I'll let you know. But yeah, lots of money you've got locked up in that 401k, unfortunately, but we can try to help with it. So JF says, my dad's 67. Is it worth setting up a policy for him, or is it too late? No, it's not too late. I got policies on my parents when they were in their late 60s. If I can, what would the minimum I would need to pay monthly or annually? Generally speaking, the minimum is above 60. It's age times 15 per month. So you would take your dad's age of 67 times 15, whatever that number is, that's how much on a minimum basis you'd want to put into that policy each month in order for it to grow enough. You can put in less, but if you put in less, it's going to be anemic. It's not going to grow enough to really use for infinite banking. All right. So Diane says this is very helpful. Thank you so much. 69 RMDs are already killing me. All right. So Diane, what I would do, since you're already past 59 and a half, so you don't have the penalties. I would start systematically taking money out up to your tax bracket, your next bracket. So a lot of people don't realize that taxes are in brackets. Like my dad didn't even know that they were in tax brackets like a couple years ago. So basically your first 0 to 15 grand or whatever the bracket is, there's no taxes. And then your next bracket, 15 to whatever it is, 28. I don't know the exact brackets, but that bracket, you're taxed 10%. Then on the next bracket, it's another percentage. So what I would do, Diane, is I would look at where your income is and where it's going to be for the year. And then right at the end of the year, I would take out as much as I can of your 401k, withdraw it since you won't be penalized without going to the next bracket. So I would do that for sure, because then you're not going to go into another bracket and get taxed more, but you're going to be able to get as much out of that 401k as possible that year. I would then take that money and I would put it into, this is me personally, I would put all the money first into properly structured whole life. The reason I think that's the place money should always go first, it's the best foundation for your money. Every dollar that goes there can't be touched. Lawsuits, judgments, liens, it's a private contract. So only you can touch it. So it's very, 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 very safe and secure. It's guaranteed to grow. It'll never stop growing tax-free. So IRS doesn't get their hands on your money. You get dividends based on how profitable the company is. So it's guaranteed to grow, plus a dividend gets you around 5 to 6% tax-free growth, 100% tax-free. So it's not a huge amount of growth, but it's steady Eddie, 5 to 6% tax-free every year. So the money just keeps getting bigger and bigger and bigger, and it can't be touched. It's protected from lawsuits and judgments. And then what you can do is immediately in the first 30 days, borrow from it, or I'm sorry, borrow against it, so you don't interrupt all the growth, and go take it to invest in something that's going to give you a nice steady return in retirement. So at 69, you're probably in retirement or thinking about it. I would start doing private money deals. Those are super, super passive. You don't got to do much for them at all. You have to do a little bit of homework up front to make sure you're not lending to the wrong person. You have to probably set up an LLC. That's probably the smartest thing you could do is set up an LLC. You want passive income during retirement. So a private money deal is super passive. You would need to set up an LLC so that you're lending from that LLC. That'll give you different tax write-offs you can do when you have a business. So you can pay less taxes on the earned income that you're getting from the private lending. So then what you're doing is recap. You're getting right up to the next bracket with your taxes without going over, getting as much out of that 401k as you can. You're not paying a penalty because you're over 59 and a half. You're taking it, putting into a specially designed whole life insurance policy to get your protection against lawsuits and judgments, get the steady Eddie growth. Oh, and by the way, get you a big death benefit for your family because you're going to pass away at some point. You take the funds, start lending it on private money deals. I lend at around 15%. So you'd be making 15% plus you're making 5 to 6 in the policy at the same time. It's a beautiful thing. The next year, what you're going to do is you're going to do the same thing. You're going to see where your income's going to be at and go right up to that next tax bracket. And you can Google tax brackets for 2025, tax brackets for 2026 next year. It'll tell you down to the penny what the bracket is. Go right up to that bracket, get as much as you can out of the 401k, put it into the policy again, rinse and repeat. So that's what I would do 100%. If you'd like my help on it, shoot me a DM on Instagram. It's Mr._Burr, B with 4 R's. And I'll be glad to help you with that. Let's see. Tisha said, I just opened an S Corp with a couple of partners to conduct fix and flips. We are considering hard lenders for the first flip. Is that a good idea, or should we borrow from friends and family? So a hard money lender is good because they'll lend on the asset. As long as it's a good asset, they'll lend on it. They don't care about your credit and all that stuff. Friends and family, I wouldn't particularly lend from them yet because you don't have proof of concept yet. You don't want to burn bridges with friends and family. If this goes south and you burn a bridge with a hard money lender, it's a hard money lender. You don't want to burn a bridge with a friend or family when you haven't done it before. And if you lose their money, that's not good. So I would start with the hard money lenders. If it's a good deal, they'll lend on it. So that's the big thing is friends and family, they might not know if it's a good deal and if it's risky. If you're getting from a hard money lender, they're going to know if it's a risky deal, if it's not a good deal. So they won't lend on it. If they don't lend on it, that means, oh, I probably shouldn't be doing this deal anyways. So that's my best advice there for you. Diane, as opposed to a Roth. So if you're referring to like what I was explaining before, then yes, I would definitely use a whole life policy opposed to a Roth because a Roth is not protected from lawsuits and judgments. It has limits on how much you can put in per year, and it doesn't give your family a death benefit. So it's not as good of a vehicle to use as a foundation as whole life insurance because whole life insurance gives a guaranteed growth, a Roth doesn't. Whole life insurance gives the creditor protections, a Roth doesn't. Whole life insurance gives your family a death benefit when you pass away. It's going to happen. Hopefully it's way in the future, but it's going to happen. A Roth doesn't. So it just gives you more benefits and you have the same amount of liquidity. So I would definitely do a whole life insurance policy. It just has to be structured correctly. That's why I want you to reach out to me so me and my team can help you structure it correctly. JF says, when you take a loan against your policy, what is the percentage of interest? Great question. So when you borrow from a policy, first thing is it's simple interest. So what that means is you're only paying interest on the balance. Now, the interest rate is generally right around 5%. And the way it works, it goes off of your anniversary date. So let's say you do a policy, you start it today. Your anniversary date would be whatever today is. What is today? The 17th? Yeah. It would be the 17th of June every year. So on the 17th of June, your rate could change. And there's a cap of 8%. It can never go above 8%. But see, with life insurance, they play the long game. So they're not changing rates all the time like crazy because they're just playing the long game. They're betting on you living a long time. If they don't think you're going to live a long time, they're not going to insure you. So rates, they don't go like this and drop back down like the market. They're kind of just steady Eddie, right around 5%. The reason for that is that when you borrow from a policy, you are one of the ways that the insurance company is profitable. So when you pay that interest rate, that helps the insurance company make profit, which is a good thing because it's a mutually owned company. So when they're profitable, you get a dividend. So your dividend just adds to your cash value. It gives you a bigger death benefit. So you want the company to be profitable. And this is how they can guarantee you an interest rate of growth with your policy. Generally, the companies we use, the guaranteed rate is 2% to as high as 3.25%. So they know they're going to be able to have your money grow by at least 2 to 3.25%. If you're borrowing at 5, if they're lending the money out to banks and institutions, they know they can pay 2 to 3.25% all day long. So the interest rate is simple interest. If you're practicing infinite banking, you're borrowing from it and then you're putting that money to use. Let's say if you're paying off a debt, if your debt is $500 a month and you take that 500 you were paying on the debt and you pay it back to your policy, you're paying down the loan balance, which means you're paying less interest. And then as you do that, every time you feed $500 back to your policy, that was money you used to lose. When it goes back to your policy, you have that 500 available again. So if you do that for an entire year, that's $6,000 of extra money in your policy you can use now. Without penalty, without questions asked, you can use it anytime. That's the infinite banking concept. Borrowing from the policy, putting the money to work, and then paying the money back to the policy to lower the balance on the loan, lower the amount of interest, and get more money into the policy. Because a debt you were paying, if it had 10, 15% interest, 20% interest if it's a credit card, that means you're getting that much interest back into your policy that you used to lose. You used to lose it forever, but you're getting it back into the policy where it's protected and it's growing tax-free, guaranteed. That's the infinite banking concept. So Diane, she says, wow, thank you so much for this info. I'd love to learn more about being my own bank and how you set that up. So Diane, definitely reach out to me on IG. This webinar today was supposed to be me presenting infinite banking, presenting the concept, how it works, how you can use it in your life. So I'll do it again next week. I will make sure the night before that my laptop is charging. So if you want to jump on that one, or if you want to reach out to me on Instagram, we can go from there. Mike says, are whole life policies protected from divorce? So that depends. If you're in a community property state, I forget what all of them are, like Arizona is one of them. I know that because I live here. Then what's yours is hers and what's hers is yours. That just is what it is. As far as like if you're not in a community property state, I don't believe that you have to disclose that information in a divorce because it is a private contract. And if your spouse knew nothing about the policy, it's a private contract. You don't have to disclose it. So there are some sort of protections there, but if your spouse is like the beneficiary, she knows about the policy. So she might request, or he, if the spouse is he, they might request a portion of the cash value. So just keep that in mind. But community property state, for sure, everything is shared. Let's take a look and see if New York is community property. New York, community property states. California, Arizona, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin. So New York is not a community property state. What I've been doing a lot of, guys, is focusing on YouTube content, longer form YouTube content. Anyone who's followed me for a while, I started just making short form content on TikTok late 2020, and it blew up. It was like perfect timing because everyone was at home during COVID. They're all on their phones. And I started making content about infinite banking, how I was using it with real estate, and it blew up. I had a few 100,000 followers in just a couple months. I think on TikTok now I'm at like 800,000. Instagram, I'm at 301. Short form content just doesn't do well anymore. So I'll put out a video, guys, on Instagram, and I think it's a great video, and it doesn't get many views. It doesn't get much traction. So it doesn't help my business at all. My business is, for the most part, helping people with infinite banking. So that's like my core business. And then from my income with that, I do private lending, I've invested in real estate. So what I've done a lot of recently is transition to YouTube to get long form content, more information about how this concept works with infinite banking. So if you guys can go check out my YouTube if you haven't already, subscribe to the channel, like the videos, comment, share the videos. It helps the algorithm. I would really appreciate it. Trying to grow that channel, it's very difficult. YouTube is a different animal. So whoever is not following me on there, it would be greatly appreciated if you go check it out. I try to give a ton of content on there, so I'll be doing that later today. I appreciate all you guys who jumped on. Thank you so much. I will see you guys next week. Go check out my YouTube, Mr_Burr, B followed by 4 R's, just like you see here. I appreciate you guys. Till next time. Peace.